Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. Google faces a critical capital allocation challenge: how to raise 50 billion rupees to fund its ambitious research and development initiatives. With interest rates in flux and capital markets reacting to economic uncertainties, the decision carries significant implications. Bruno Santos, a senior financial analyst at Google, is tasked with evaluating the optimal debt structure for this substantial issuance. Every basis point matters, not just in cost, but in how the financing aligns with Google's long-term innovation strategy and financial risk appetite. The options range from short-term floating-rate instruments to long-duration fixed-rate bonds, each with varying impacts on the company's interest burden, credit outlook, and balance sheet flexibility. The chosen structure will influence not only the cost of capital, but also the perception of financial prudence among investors and credit agencies. Bruno's recommendation will directly impact CFO Ruth Porat's broader financial strategy, making this more than just a funding decision. It's a strategic lever in sustaining Google's innovation engine while navigating market volatility. Google faces the challenge of raising 50 billion rupees for research and development amidst fluctuating interest rates. Bruno Santos, a senior analyst at Google Treasury, is tasked with recommending the best debt structure. Each basis point is crucial in this significant issuance, with the final decision presented to Chief Financial Officer Ruth Porat. Google chose debt financing to preserve liquidity, aligning its capital structure with industry norms. This approach optimizes the cost of capital amid volatile interest rates, ensuring financial flexibility for future strategic opportunities. Despite substantial cash reserves, this strategy safeguards against market downturns, maintaining a competitive edge. In mid-2023, the Federal Reserve's aggressive rate hike cycle resulted in a high-rate environment. Speculation about potential rate cuts added uncertainty to future rate trajectories. This heightened market volatility made the timing and structure of debt issuance crucial for ensuring long-term financial stability. Fixed-rate bonds offer stability but can be expensive if rates drop. Floating-rate bonds start cheaper but risk higher costs if rates rise. A hybrid approach using interest rate swaps allows for simulating fixed rates or hedging specific exposures, providing strategic flexibility in managing debt amidst fluctuating interest rates. Interest rate swaps allow corporations to convert fixed-rate debt to floating rates or vice versa, creating synthetic positions without altering underlying instruments. They enable strategic positioning and hedging based on market forecasts, offering adaptability to dynamic conditions. This flexibility helps manage debt profiles with precision in an uncertain economic landscape. Swap-adjusted interest cost helps determine true financing costs by factoring in swap payments. Yield curve analysis interprets short and long-term rate relationships to identify market opportunities. Duration risk assessment evaluates sensitivity to rate changes, while forward rate projections analyze market-implied future rates to guide floating rate exposure decisions. Analyze the yield curve, forward rate expectations, and swap spreads to establish a baseline interest rate outlook. Evaluate worst-case scenarios for each financing structure under varying rate environments. Calculate expected financing costs across multiple scenarios. Ensure recommendations align with Google's liquidity needs and peer capital structures. Short-term interest rate outlook involves analyzing recent Federal Reserve communications, economic indicators like inflation and employment, and market liquidity conditions. Long-term considerations include structural economic changes impacting the neutral rate, long-term inflation expectations, and potential shifts in monetary policy regimes. These factors are crucial for forming a comprehensive interest rate outlook. Fixed-rate bonds offer predictable payments, minimizing risk, but often at a higher initial cost. In contrast, floating-rate bonds present higher risk due to potential payment increases, but can offer lower initial costs and benefits if rates fall. A hybrid approach balances these, allowing for fine-tuned exposure and optimized returns, achieving cost efficiency. Effective corporate treasury strategy emphasizes robust financing structures that perform well across various scenarios, avoiding reliance on single interest rate forecasts. A portfolio approach to debt, diversifying instruments and maturities, naturally hedges against interest rate volatility. Google's strategic financial management exemplifies this approach, showcasing its effectiveness at scale. In technology, cash-rich firms often opt for floating rates to reduce short-term costs, preserving liquidity for acquisitions. Manufacturing sectors, being capital-intensive, prefer fixed rates to align with stable long-term asset returns. Banks match liability structures to asset portfolios, minimizing basis risk. Healthcare businesses use swaps to optimize debt costs, ensuring predictable payment schedules. Google faces a strategic decision. Issuing fixed-rate debt amid potential rate declines involves weighing risk-reward trade-offs. Interest rate swaps can balance cost and risk management. Companies must time capital raises carefully, considering Federal Reserve policy uncertainty. Yield curve signals and forward rates are crucial in Google's financing decisions, guiding optimal capital structure choices. Explore the practical application of interest rate swap mechanics in corporate finance. Delve into strategic decision-making under uncertainty in treasury management. Analyze financing alternatives using duration and interest rate models. Understand how macroeconomic factors influence optimal capital structure, enhancing strategic financial decisions. Thank you for exploring this finance-driven case with Skilled MBA. For more practical insights and case study videos, mobile +91 875 53 00795. Email support@skilledmba.com. Website https://skilledmba.com.